Hello and welcome to this podcast on the topic of participation agreements. I have with me Chris Sykes, who is a solicitor and partner with Sykes Anderson. Chris, I own a flat in a block based in central London. There are 120 flats of various sizes. I've been looking at buying a freehold. Well, most of the flat owners are interested in doing this, and I've put myself forward as their spokesman. In other words, sorting out what has to be done and who is doing it. I expect we will have to get a valuation before we seriously commit to the process and maybe form a company. Now, what really worries myself and some of the other flat owners is binding everyone involved to something that may well take a long time. Now, I've been doing some research on the internet and I've seen a reference to something that may be relevant, and it's called a participation agreement. Can you explain what it is?
Yes, Nick. A participation agreement is there to address precisely the issue you've mentioned, and it's agreement between the proposed participators to a collective enfranchisement, and it sets out the basis of their participation. It's intended to bind participators to the collective process and to each other, and also to the new company which will be formed to acquire the property. It's important to note that it is a legally binding document, whether it be in a short form, as is used in some cases, or more usually a longer standard form document, which would probably be more appropriate for a block of your size.
Thank you. Now, just wondered, can we actually do without one?
The simple answer to that is no. This is particularly the case in a large block such as yours, but it's pretty much essential in all cases. Each participator will want to be sure that his or her co-participators will pay their contributions to the price and costs when required. It could have very serious consequences if there were no agreement and a participator could withdraw on a whim. So, for example, this would increase the level of contributions payable by the remaining participators, and in a worst case scenario might derail the project entirely. So, therefore, it's very important that all the participators are legally bound to the process. The participation agreement would also set out all the key aspects of the participation. So, for example, with regard to the amount that participators are likely to have to contribute, and the benefits they may obtain if the project is successful and the freehold of the block is acquired. There may also be special circumstances which need to be dealt with. For example, if the price of a non-participating flat is payable by one or more of the participators, rather than divided between all of them, or by an outside investor known as a white knight.
Thanks so much, Chris. I just wonder, I'd like to have a sort of more comprehensive idea of exactly the sort of issues that should be addressed in the participation agreement, and maybe you could take me through them.
Yes, Nick, I will do. There are quite a few elements which need to be covered, and let's have a look at the key ones. So the first thing is the percentage of contributions to the price and professional fees. So one of the most important questions that any prospective participator is going to ask is, how much am I going to have to pay? And they're also going to want to know, how their contribution is to be calculated and the maximum amount they've got to pay. As you've indicated, it's essential to obtain a professional specialist valuation, which would set out the likely maximum and minimum price, and what the valuer considers to be the likely final price. You would also have an estimate of fees from the solicitor you are using in the process. Once a claim notice is served, there is a liability to pay the reasonable costs of the freeholder and any other landlord. Although these costs are less predictable, your solicitor should be able to provide a rough estimate allowing a margin for error. So that once you've got an idea of the total you're going to have to pay, you're going to have to look at the way in which the contributions are going to be calculated between the participators. And I think you need to look at this in three aspects. The first is the part of the price attributable to the interest of the participating flats. Secondly, to look at the part attributable to the non-participating flats, because you have to pay for those interests as well. You're buying that interest in the whole building. And then the contribution towards the costs. If all the flats are of a similar size and value, then equal contribution to the price might be appropriate. But in most instances, this is not the case, and is unlikely to be so in your block. So that, for example, it's generally unfair for the leaseholder owning a penthouse to pay the same as one owning a studio flat, where the owner of a penthouse would obtain a greater benefit following a successful purchase of the freehold. The proportions of the price of participating flats are commonly based on the comparative service charge percentages, or they could be paid based on comparative square footages. Also, a more sophisticated option is to allocate the price according to the interest of each participating flat based on their comparative values. This is particularly useful when the flats have different lease lengths. So, for example, some flats in the building may have extended their leases and have very long leases, and others may have short leases. And that method of contribution caters for that circumstance. Often in larger blocks there will be a large number of flats which do not participate, but the price for the interest attributed to those flats must be paid for. The proportions for these interests could be the same as the contributions to the price for participating flats, or they could be on an equal basis, as there may well be an equal benefit to all the participators as shareholders of the new freehold company. It is also possible that the price for non-participating flats may be covered by a smaller number of participators or an outside investor, as I have previously indicated. Whatever method is chosen, you must make sure that the contributions add up to 100%. I'd also recommend that your methods be tested to make sure that the correct result is obtained. Looking at the payment of costs, contributions could be on the same proportions as the price of participating flats, or more commonly on an equal basis. However, this is a matter for you to discuss with your fellow participators as to what's fair and appropriate for your particular circumstances. The agreement will normally state when the contributions to the price and cost have to be paid, and as you would imagine, sometimes these things have to be paid in stages. Normally the costs have to be funded on account as you go along, and if there's a contract to buy the freehold, then you may have to pay a deposit. Our next item is the withdrawal from the process. Hopefully none of the participators will want to or need to withdraw, but this is an aspect which does need to be covered. So the agreement usually provides that the participator can only withdraw in certain circumstances. This is often by reference to a cap, and clearly most participants want to know what is the maximum figure they are obliged to pay. The cap is usually by reference to a maximum purchase price and or costs. If the total goes above that, or if it is almost certainly going to do so, then unless agreed otherwise, a participator can withdraw without penalty. If a participator withdraws without being able to do so, and is therefore in breach of the agreement, then the agreement would provide for an appropriate sanction, usually a liability for some or all of the wasted costs, or it could extend to all the losses. And this is a matter you have to agree when looking at what's appropriate for the participation agreement. Next, going back to the issue of contributions, we can look at how these are treated. This is a technical aspect, but it's important to decide the treatment of participators' contributions for the purposes of the new freehold company. So following completion of purchase, the property will be in the name of that company, and the basis on which it holds the property and the way in which contributions by the participators are treated in the books of the company for accounting and tax purposes have to be addressed. The main choices to be made are firstly between the company holding the property and contributions as nominee. This in essence means that the company is simply a see-through for tax purposes. Secondly, alternatively, the company can be the beneficial, i.e. the true owner of the property, rather than the nominee, with the participators' contributions being made to the company by way of loan. This loan is normally repaid by means of the grant of a long lease to each participator of their flat. It is important this is clarified early on, otherwise there is likely to be confusion and problems later on. Your solicitor should be able to give some guidance, but essentially this is a matter on which the advice of an accountant should be obtained, preferably one who is knowledgeable about leaseholder-owned freehold companies. An accountant will be needed in any case to provide the annual accounts of the company. possibly also to deal with filing of returns for it. It is a bit technical, but in essence the choice is between the company as a nominee and the company as a beneficial owner being funded by loans. Next, one question most prospective participants in a collective enfranchisement exercise ask, whether invited to join, is, what is in it for me? So leaving aside the more intangible benefits of owning a share in the freehold, and the possibly more tangible benefit of an interest in any latent value in the freehold, the most important benefit for a participator, what every participator wants, is the grant of a long lease of their flat. This is giving them a virtual freehold in their flat. So the lease would be for 999 years, and the ground rent would be reduced, often to a peppercorn, i.e. nothing, or sometimes some level of ground rent liability is maintained to fund the running costs of the freehold company, such as the cost of annual accounts and returns. This really depends on what other income the freehold company might have. For example, it may be getting in sufficient ground rent from non-participating flats. So the granting of new leases also gives the opportunity to see whether any improvement in the terms of the new leases should be made, and this can be covered in the participation agreement. For example, including provision for a reserve fund where one does not exist in the existing leases. However, it's important to be aware that it's not possible to change the leases of non-participators, and caution needs to be exercised to make sure there will still be a consistent management structure, and, for example, it's difficult to change the service charge percentages. One other event that sometimes occurs during the process, particularly in a large block such as yours, is that a participant wants to sell their flat while the claim is proceeding. So we need to cater for that in the participation agreement. What normally happens is that the seller is obliged to procure that the buyer steps into their shoes. This may create some small problem with, or complication rather, with the sale of the property, but they're generally through problems in practice. The buyer would sign what is known as a deed of adherence, so that they are bound by the terms of the participation agreement. Another question which arises is what happens with non-participators who might want to join in at a later stage. Something that many leaseholders are not aware of is that it's not necessary to invite every flat owner in a building to participate, although in most cases desirable, as generally people want to get as many participators as possible to reduce the level of contributions to the price and costs each participator has to pay. Interestingly, it's sometimes better financially to have fewer participators, particularly where there are leases of 80 years or less, but this needs to be considered carefully with specialist advice. There is no obligation to invite a non-participator to join in the process at a later date, although in most cases the door is kept open for them to do so.
So tell me about the new freehold company.
Well, you've got to think about how this is structured and how it is run. So an essential point is it a company limited by guarantee or by shares? I think to keep the answer simple, in your case it's going to be one which is limited by shares, so this provides more flexibility. The shareholding in the company is usually on the basis of one share per flat. The Constitution will provide that if a leaseholder sells their flat, then they must transfer the share to the buyer, with the idea being that ownership of shares is kept within the building. There may need to be special provision for shares relating to investors who have bought the interest in non-participating flats. The participation agreement will cover these various aspects and might also cover matters such as who are to be the initial directors of the company, and although the final composition of the board may change either during or at the end of the process. And with regard to directors, they do need to be aware of their legal responsibilities.
Thanks. I just wondered if you have any final thoughts for our listeners.
Yes, Nick, just a few final thoughts. So if a collective enfranchisement is not feasible, well, hopefully it will, but it may be that the cost is too high. And if, for example, poor management of the building is an issue, then the possibility of making a right to manage claim should be looked at. The qualifying criteria are very similar as those for a collective enfranchisement, but it is cheaper and quicker than trying to buy the freehold, and it is a no-fault right, so it's very difficult for a landlord to prevent it if all the boxes are ticked. Also, if collective enfranchising is not possible, then each leaseholder should look at exercising their statutory right to extend their lease, provided that they have owned their flat for at least 2 years. And they could either do this on their own, or they may look to collaborate with a number of other leaseholders in the block to get the benefits of economies of scale for both negotiating power and costs. Another thought, a point to remember, is that if, as often will be the case, the freehold company takes over the management of the building, and it may delegate some of the responsibilities to professional managing agents, particularly in the case of a large block such as yours, the company does step into the shoes of the landlord in terms of compliance with all the legislation and regulations imposed on the owners of blocks of flats, such as following the Section 20 estimating procedure for major works. I think some people are under the impression that there is a different sort of set of rules applying when it's a leaseholder-owned block, but this is definitely not the case. Finally, if there appears to be enough interest in participating in collective process exercise, that is normally down to the determination of you and maybe one or two other lead participators to drive through the process. And in my experience, with determination and persistence, you should succeed.
Thanks very much, Chris, for taking us through participation agreements, and thank you very much for listening.